Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and we're coming to you live at 5 p.m. Eastern Time as we typically do. And today is January 21st, 2026. And we've got a great show for you. Of course, Katie Stockton is going to be joining us again. She is the founder and managing partner of Fairlead Strategies. Welcome back to the show.
Thank you, Justin. Good to be back.
Good to have you. It should also be mentioned you've got those special letters at the end of your name, CMT. We've had a few CMTs on recently, so definitely good to get in the charts. And a lot of people might have some familiarity with Katie because she's often on CNBC as a contributor there. You're pretty regular, I feel like, on that show.
Yeah,
You pop up every now and then.
they keep me busy for sure.
Yeah, perfect. Well, I mean, this market is keeping us busy, so let's dive right into it. I think the biggest issue that folks are dealing with, certainly with the new year, and maybe even the end of last year, is that we have just kind of gotten a lot of sideways activity. I'm showing the Nasdaq Composite right now, but even if you look at the S&P 500, if I can pull that up, you know, since October, it's really kind of been in this very sideways, range-bound area. And while the S&P 500, I mean, it broke out to new highs. But I say that with kind of a quote unquote because it didn't feel like there was any oomph behind it. It just couldn't stay above those resistance levels. So, what do you think right now of kind of where the market's at? And especially recently, since we just had this touch of the 50-day moving average line and a nice bounce today.
It's a really good point about the breakout and the lack of follow through for the S&P 500 because we just saw something pretty similar in a way from the Nasdaq 100, which broke out from what looked like a triangle formation and then it saw no upside follow through. So we're not really seeing great reactions to breakouts for these large cap proxies. Where we are or have seen better reactions are on the small and mid cap front. And of course, that has also positively impacted the equal weight proxies too. So it's been a really interesting year to date for 2026. The rotations that have occurred to the benefit of the smaller cap benchmarks like the Russell 2000 over the S&P 500 and Nasdaq, which are, as you said, more range bound. They're range bound, but still really very close to their highs.
Yeah.
So I don't want to make too much of that action. We've seen a very distinct loss of intermediate term momentum within their longer term uptrends. And yet that hasn't done too much damage when you just look at the absolute price level versus the all-time highs. So we do want to honor that bull market cycle that's of course driven those new highs, and we also want to honor the fact that long-term momentum is still positive. But indeed, we have seen a pickup in volatility, and certainly the large cap relative performance has suffered a little bit with technology stocks falling out of favor, which is something we're not accustomed to.
Right, exactly. It's usually, all tech all the time. And while AI is certainly still getting a lot of headlines, and it does seem like there's a lot of the kind of picks and shovels plays, if you will, whether it's data centers and everything like that, that are still, acting very nicely. And I'm, looking at, some of the, I mean, SMH, for instance, the VanEck Semiconductor ETF, it doesn't look like there's a problem here, And so if you're thinking, oh well, tech, equals chips, it's like, oh, what are you complaining about? But then if you look at IGV, for instance, oh, that's a very different look. IGV, of course, is the software, a software ETF. So very different, I guess, bifurcation even in the tech space.
Yeah, that's for sure. And that's created a bit of a tug of war, right, in the
Hmm.
broader technology sector where there have been very distinct winners and losers. And the semis versus software is probably the best example of that. I just pulled up SMH, and boy, it couldn't look less like IGV as ETFs representing those two spaces.
Yeah.
But even within the semiconductor sector, you could pick that apart and say that the groups are starting to diverge too within the
Yeah.
broader semi space. So some real rotations are underway, and I think Now that we're, 3 weeks into the new year, so we should start to see some of that normalize, would be my guess, because that start of the year rebalancing that happens is probably running its course at this point. And now I think folks will turn their attention to earnings. And we, of course, have earnings from the mega cap complex coming up here pretty soon.
Mhm.
And that's something that'll be really interesting to see the reactions given how oversold some of them are coming into those reports.
Yeah, and it's worth mentioning that just as you said, even within the group like SMH, the semiconductors, I mean, Nvidia is 18.5% weight in SMH and looks just so different. So I mean, it's almost like Nvidia now is a drag on SMH, and it's kind of your, I don't know, your KLAC,
Hmm.
that,
Micron, yeah.
LRCX, Micron, of course, these are the ones that are doing the heavy lifting, and kind of dragging, Nvidia along with them. But
Yeah.
to that end, oh, I'm sorry, were you going to say something?
Well, I might just add that Broadcom could be
Yeah.
lumped with NVIDIA and the way it's trading.
Hmm.
NVIDIA is not reporting as soon as the other mega caps either. It's not until late February that we get that earnings report. But I do think that there's a chance it could be lifted if we see a positive reaction from the likes of, say, Apple and Meta, just by
Hmm.
the nature of folks getting more confidence back into that mega cap complex. So we'll see how it unfolds. But without question, we have seen some big winners and losers in the semi space. And the analog semiconductor companies seem to have emerged, in AMD, Texas
Yeah.
Instruments. We highlighted recently
Intel,
SPI.
Intel's
Intel,
like,
very exciting. Yeah.
with Left for Dead. I mean, if you look at the monthly chart, and how the relative performance was just nothing to write home about for 2 decades here, and
Mhm.
now all of a sudden it's like it's I don't know, not like it's 1999 again, but certainly been a while since Intel has been on our
Yeah.
radar.
Yeah. It's been
Uh,
interesting.
yeah. Speaking of the large caps, I'm just going to pull up FNGS here as a kind of a proxy for your mega caps. Um, do you have a preference in terms of one that you look at? No matter
Well, we
how you
have, yeah.
view it,
Well,
it's kind of like, ugh.
as a complex, right? We have a Mag 7 index that we track. There's, of course, ETFs like this FNGS.
Mhm.
And when you look at the Mag 7 or the mega caps collectively, they do look like this with this corrective phase. This Mag 7 proxy you had me pull up is right down on its 200-day moving average. And
Mhm.
that's following a pretty deep correction. So, and that is, of course, a divergence with what we're seeing from the major indices, especially on the small and mid cap front. So it's a distinct change from what we had been accustomed to up until about October. So a real change
Right.
in character. And I do think that it sets a bit of a different tone for 2026 versus 25, 24, and parts of 23 in a
Yeah.
way, and begs for a broadening out of the uptrend in order to keep it going. The bull market cycle we're going to assume is going to stay intact, but it will require, I think, better participation on perhaps the sector level and also, of course, the individual stock level in order to sustain itself. I would guess that without relative performance kicking back in earnest from the mega cap complex, it's just going to be harder. It'll be a more difficult tape for most investors. But the mega caps are, as you can see on this FNGS, pretty oversold by most metrics ahead of their earnings reports, which start next week for the most part. And I think that's interesting, not because the charts will necessarily give you an edge into earnings, but I just feel like in general, when you see a downdraft of this magnitude ahead of an earnings report, the stock has a better chance of responding positively because there's
Hmm.
less of a proof point that needs to be achieved, given something that's appearing overextended on the upside. So it's just a market psychology takeaway more than anything else. But with this downdraft in the likes of Apple and Microsoft and Meta, they're all pretty beaten up as we come into their reports.
Yeah, and probably one of the exceptions, of course, is Alphabet. That one pulled back to its 21-day moving average line and looks very different. I do have a
That's
position
right.
in
Yeah, it does.
Alphabet myself, but it's definitely very different looking than the others. And I guess I'm going to push back a little bit because while, yes, I think, when you look at the indexes that are market cap weighted, it does look like it's tougher, but because maybe there's this broadening out, and maybe I'm speaking from my own experience, 2023 and 2024 were at times tough. I felt frustrated sometimes because I was not outperforming the indexes because I
Hmm.
didn't have enough Mag 7 exposure. I was trying to broaden out and the market kept on telling me, no, stop. It's just, there's 7 stocks to care about and that's all, kind of thing. Whereas now I feel like that there's more areas to choose from. And, granted, there's still some volatility there, but your average stock, a lot of times, again, we're
Hmm.
seeing the NASDAQ fall or the S&P 500 fall, yet there's more advancers than decliners.
Hmm.
The AD line is going up. And so I guess it goes back to what you said. It just might have to be a change in focus from what we've been used to the last few years.
That's right. There's also a difference between breadth and leadership.
Yes.
We actually
Good
didn't
point.
have terrible breadth or participation in 23, 24, 25, but we did have somewhat narrow leadership to large cap tech or the mega caps for the most part. And that's, I think, in a way, an easier tape for most investors because they generally have oversized tech exposure. And when you come into an environment that perhaps real estate or energy or consumer staples are doing better, well,
Hmm.
my guess is that some folks are not going to be positioned to take advantage of that. So that's where I think it could be a bit harder, but also opportunity. Usually, when there is more volatility, which I think there will be this year, and more rotation and broad participation, that is opportunity. So there are ways that you can be maybe more of a trader and look for good opportunities to add and perhaps pare back as we see these like intermediate term swings unfold. It just maybe requires a bit more active management.
And you know, you bring up the staples because again, it's funny how you see a lot of strength in the small caps and staples. You usually think of it as being more defensive, yet there's a lot of again growth names that are doing so well. So you yeah, it reminds me of how well like the utilities were doing for so long. Now, granted, a lot of those were doing well because of being AI adjacent, because of the power needs and
Hmm.
everything. But what do you kind of make of something like where these typically defensive areas, and now granted, you can kind of pin some of the strength and staples to some big weights in this ETF, Walmart, for instance, and Costco, and things like that. But what do you kind of make of staples being so strong when that's usually defensive in nature?
Yeah, so they've been strong in absolute terms. They've participated for the most part or as a sector, but in relative terms, just until very recently, they've been pretty terrible. So the relative performance, I think, is what informs that either defensive or more aggressive positioning on the part of investors. And indeed, it has become a bit more defensive since we've seen that rotation that started with the year kicking off. But I think it might dissipate a little bit, especially if we get a mega cap relief rally. That's something that would then probably pretty quickly trickle into near term underperformance from the more defensive areas of the market. But I think it could be a more balanced year in general for some of these more beleaguered sectors, the same sectors that had underperformed and maybe even close to flat on the year last year could emerge as better opportunities this year. And maybe we could talk about energy to that end,
Hmm.
where the energy sector, if you look at it from a long-term perspective, is very much a trading range referencing the S&P 500 energy index. But we have, with the short-term breakout in crude oil, and now, of course, also natural gas with this cold
Oh,
snap.
yeah. A little bit of a move there, right?
That's right. Yeah. And you now have improved long-term momentum to suggest that energy will emerge as at least a better relative performer, and perhaps one that even breaks out from this range in absolute terms. So that kind of setup's intriguing. In general, as a technical analyst or CMT, you could imagine we prefer long-term uptrends. But when we have a more defensive market, a correcting S&P 500, or even worse, a downtrending S&P 500, that is when we need to get a bit more creative and either source these other areas of the market that are lesser correlated for opportunity, and or use asset allocation, and overweight the defensive areas of the market on the sector front.
Well, and here again, almost like in the same way that we talked about with SMH, the semiconductors, the energy sector is very diverse too. You have some of these areas that are very different, and even we often refer to our groups as oil and gas, but oil and gas, which one is it? Because those can act very different. So,
Yeah, they
how
sure
do you,
can.
yeah, how do you kind of do that, next level dive to kind of, do you want the broad, XLE exposure, or do you want to get a little bit more specific, like into the field services, like OIH, or the explorers and producers, like XOP, or even just the commodities themselves, with either like a UNG or a USO for gas or oil, respectively?
Yeah, it's a good question. And it's funny because our research on the sector level is called sector deep dive.
Hmm.
So we are doing the dive that you reference. And we're taking typically the top sort of 50 names market cap wise in the energy sector, and evaluating them for different characteristics. Then we'll also do some group work. And you can find there are some rotations on the sector level, just like we referred to regarding the semiconductor sector. There are different characteristics to different groups. But typically, we like to just even go to the commodities themselves, and you can do that through ETFs, as you mentioned. And
Hmm.
that way, you're getting that commodity exposure, which ultimately should trickle into the financials of these companies. And we're big believers in buying breakouts. So when you see a range resolve to the upside, or even a turnaround where a stock has been downtrending, breaks out above the 50-day moving average, or something similar to that in terms of a resistance level, that is where we feel like we have action items. So whether that occurs on the group level, for something like an OIH, or on the stock level, we're kind of agnostic to that. We just want to be there where there's a technical catalyst. We've already seen those types of catalysts unfold within the energy complex. So, but it's still mostly counter trend or sort of early stage advances from ranges. We don't have a vast majority of long-term uptrends like you still have in the winning areas of the market, like technology and communications. It's just that those are more likely to pull back if we see a correction in the S&P 500. So I think it's all about reconciling the top-down views with how you feel about the individual sectors.
Hmm. Well, and I want to kind of again take that step back because we've been talking a lot about these sector rotations, and even from the outset, as you mentioned, let's not get too bearish on the indexes even when they're just a percent or so from all-time highs.
Mhm.
So taking that step back and like looking at even the like a long-term chart or even a monthly, it's it's very hard to even like, well, what are you worried about, when you see this, strong uptrend. So I guess how do you go back and forth between these daily, sometimes it feels like daily rotations and daily actions and volatility, to that long-term look? What tools do you use to kind of keep that long-term hat on your head and not get too worried about the day-to-day fluctuations?
Yeah, I mean, I think it's an excellent question, because I think we do all get too caught up at times in the short term swings and the headlines that hit the market intraday. those can be really distracting to a long-term investor. What I always encourage our longer-term oriented clients to do is just focus on monthly bar charts. So eliminate a lot of the noise that we
Hmm.
suffer every day, every week, and simply look at the monthly bar charts and the indicators that go along with that, because it's really all you need, frankly, if you are a long-term investor. We only use month-end closing data for our indicators for our ETF when we rebalance. And if you have that luxury in a way of being long-term, I think it's wise, because you shouldn't go fully, risk off perhaps in a corrective phase in your overall portfolio. You should just kind of pull back, right, in terms of your overall exposure. And the long term indicators will help you navigate that in a way that you can avoid the emotional I guess, ups and downs associated with the volatility and the swings. Because the nature of the indicators that we use, and this goes across all time frames, is that they're smoothing out trends. They're
Hmm.
often based on moving averages of price. And those moving averages, by their nature, will take out a lot of the volatile look of the bar charts and give us a smooth sense of what the prevailing trend is. And those moving averages become the stuff of our technical indicators. So I think it's more a matter of ignoring some of the short term data and really just focusing in on something that is longer term. And for us, that means a monthly close. For other people, it might mean something different. But we feel like we can get a good sense of the prevailing trends that way. And we always want to keep those prevailing trends in mind. And, your point about the uptrends, and we don't want to lose sight of that. I think it's a great one, because it is easy to lose sight when we're getting knee deep in the volatility. And so when you look at the monthly indicators right now, we have some signs of exhaustion. We use the DeMark indicators to that end,
Hmm.
but we don't have any sell signals that are confirmed. So, and that's the kind of thing that would increase risk with a duration of a few months, not just a few weeks. And that's the kind of risk that we really want to concern ourselves with in terms of our portfolio positioning for TACK or our recommendations to our clients. So we'll watch for any kind of sell signals. Those can come in multiple forms. And then also for the long term indicators, while they point higher, they have downtick to suggest that there's a risk of a corrective phase in Q1, but not enough to warrant an overall, I guess, reduction of exposure entirely, because you want to maintain some exposure in an uptrend, even if you think a corrective phase is likely. And that's how we think about our own strategies. Right now,
Hmm.
we have 75% exposure to US equity sectors in our positioning, and then about a 25% piece in what we're considering to be risk off categories of gold, which is not necessarily acting risk off right now,
Right,
but it's been
exactly.
quite good.
Yeah.
Gold, short term treasuries, and long term treasuries. So there's ways to manage risk through these other asset classes.
Hmm. Well, let's talk about that a little bit, because again, some of the things that you typically think of as a little bit more risk off, a little bit less volatile, have certainly been very interesting to watch. We'll start with gold, and this is GLD that I have up, and I'm going to throw SLV, the Silver Trust, up as well. So uh, really, I mean, it seems like it's any metal that you pick. Copper, aluminum, steel. Take your pick. And even one of my biggest complaints has been, XME, which is such
Hmm.
a mishmash of things. You've got coal in there, and all these different things, and that's been on an incredible run. Um, so yeah, I guess with these commodities, sometimes it's a little bit harder to look at. It's not like you're going to be looking at the fundamental changes. It's not like, oh, there's this brand new application for gold, and it's taking over. Sometimes you can get that with copper or silver with industrial uses. So how do you kind of look at these and say, oh, you know what, this is a good place to either park money, or in some cases, like right now, grow money, it seems like.
Well, that's it. It has that dual benefit right now of having strong positive momentum, short term and long term. And then also historically having had a lower correlation to the equity market, which then lends itself to diversification in a portfolio. So those are dual benefits, and we believe that there is a place in portfolios for that. But then opportunistically, if there's something that is breaking out, like we saw in platinum last year from
Hmm.
a huge triangle formation, or palladium from a big basing phase, when you have these long-term technical catalysts and you want to make a more sort of opportunistic bet on these different metals, I don't see any reason why not to. You could treat them in the same way, in a way that you treat individual stocks, perhaps. And now, of course, we have ETFs for just about everything out there that we
Right.
can use to express a view. And
Hmm.
so I think it's a great opportunity of a trending asset class, and we're just honoring the momentum until it tells us otherwise. We don't have a way to project where gold will be, at mid-year, but we do have uptrending metrics across the board, so we're trusting that it will continue to move higher. And once we see some deterioration in the indicators, we'll also, of course, react to that. So it's somewhat reactive. If we were to see, as an example, weekly MACD sell signal and then some other overbought indications, that might be a reason to temporarily reduce exposure. But for now, the long-term setup is really pretty compelling. And you
Hmm.
can make that case from a trend following perspective to have some gold, silver, even copper exposure.
Yeah. Yeah. Very, very good points. And I'm just going to make a quick reference because as a CMT, you've done the deep dive on MACDs and a lot of different technical indicators. And, for folks looking at my charts, if you're watching the video, you probably see this little banner that says the new market surge beta version is here. Try it now. So one of the things that will be uh, rolling out and actually has already rolled out is a lot of new technical indicators on our market search platform, including that Katie mentioned, MACDs. And another thing that I know that you're into is the Ichimoku. Is that how you pronounce it? Ichimoku clouds.
Yes, yes.
Um, yeah, forgive my Japanese, but yeah, so a lot of new technical indicators will be on that beta version. So I didn't want to try them out just yet because it's in beta, and I didn't want to throw Katie off if things didn't match what she was looking at. But maybe next time that's something we can cover. So okay, so we talked a little bit about the metals. You also mentioned about parking money in kind of the treasuries, and here again, it seems like. Something that you normally expect to be quite boring, certainly just in the last couple days has been a little bit more movement, whether it's the Japanese bond market. Again, it's a little bit more interesting when news happens over the weekend with both the Japanese bond market, Greenland news in terms of some back and forth there, and we had a holiday on Monday, so Tuesday felt like this big catch up to what the world was doing on Monday. So, talk to me a little bit about treasuries. I have the 10-year treasury yield up here right now, a break above the 200-day moving average line. Um, you could certainly argue yield breaking above a downtrend here over the last year. Does that, what does that do for your, I guess, market view? Are you pulling in macroeconomic factors like this in there when you're doing your analysis?
Yeah, we call it macro technicals, but in
Okay.
reality, just looking at the individual instruments like 10-year treasury yields that have an impact on other markets, right? So it's sort of intermarket analysis, but in a way independently.
Hmm.
And that's with intention. We're not saying, well, this is doing this, so this should happen, but rather saying, well, this is doing this. What does that mean?
Hmm.
Why does that make sense? Is there something different in this environment than was the case a year ago? That type of thing. So it's macro technical takeaways to inform, I think, macroeconomic inputs.
Hmm.
So with yields, we do have a short-term breakout above resistance, and for the 10-year, it included the 200-day moving average. That was right around 4.23%, and that suggests we'll see upside follow through. But I think with yields and with a lot of things, we should zoom out and look at the long-term setup, which you can see is a really big range that has taken the shape of a triangle formation. And when you have a triangle formation, it's when you have the swings used to be quite wide and now they're narrowing. So you have a series of lower highs and higher lows. And that's what we have in yields. So it's a pretty neutral takeaway until you see a breakout or a breakdown from the boundaries of that triangle. And we don't have that yet. So we're more, watching these short-term swings with interest. But in reality, the takeaway longer term is still pretty neutral to lower when you reference some of the indicators. And there's a kind of a big overhang of resistance. So we're not making the assumption that we'll see a breakout on this near-term up move that is underway. And therein, we're not too quick to reduce any fixed income exposure. Interestingly, the TLT ETF had a counter trend, a short-term counter trend indication from the DeMark indicators yesterday. And when you have an environment that is emotionally charged and has all the macro stuff going on, especially post a long weekend, that's when sometimes there's a short-term pause or opportunity, right, to go counter trend. So these are the things that we're watching short-term, but the overall trend is somewhat neutral. And there's still, of course, appeal in treasuries just for their yield alone, which 4+% isn't bad.
Yeah, I mean it's certainly not what we got used to for a while, where it was kind of like yields that were so low that it almost pushed you into the market, because it's like, oh, yeah, I have to be in the market in order to get any type of return. Because, but yeah, with 4%, it's like, oh well, that's not nothing, and
Yeah.
especially with the low risk that those entail, it certainly makes them a little bit more attractive as a potential alternative, not just something to mock and discount completely. So very good point. I also, just again, since we're on kind of macro factors, how does like the dollar come into play for you? The strength of the U.S. dollar, or any of the currency pairs?
Yeah, we look at them all the time, and it's in a way independently as we're looking at yields and other things, just to try to inform our readers, to make something of it, right? So the chart's not going to necessarily tell you why something's happening, but
Right.
it will tell you what's happening. And when
You
we
can figure the why out later.
well, hopefully somebody else can, because we're just looking at the charts. But for the dollar index, it is a secular uptrend. But within that context, of course, we've seen a cyclical down move that's now culminated and has led to stabilization. So it's a pretty interesting setup, because you have to reconcile these time frames. So short term, it's looking lower. You've seen a pullback unfold. And yet there's long-term gradual uptrend line support that kicks in for it. So it's a bit of a confusing takeaway, because you have to say, okay, well, short term looks lower, intermediate term looks higher, and long term higher, but only gradually so. So, how does that reconcile? I'm not sure, but I do think it's certainly an important input, and particularly pertaining to international investing and using it as a hedge.
Yeah, that totally makes sense. So, to kind of just inform our listeners, again, a little bit about your style, and again, the way you approach things. I know, watching you on CNBC, I know a lot of times you are putting kind of targets out there, and whether it's expected moves, market moves, and so on. How do you kind of go about putting your targets? I think you always, what I like is that you always offer yourself the flexibility to put a target out there, but to adjust, based on the conditions that you're seeing. But can you talk to us a little bit about how you go about doing that, so that when it does hit, because I think I heard you talk a little bit about like the 6,800 or 6,900 for S&P 500 a while ago as a potential target, and then when it hits it, how does that kind of inform how you go forward?
Yeah, it's a great question, and there's, I guess, multiple parts to the answer in a way. We can use support and resistance levels to derive objectives.
Hmm.
And these are, I like the word objective in a way better than targets, but we'll
Yeah.
also use the
Hmm.
word targets.
Hmm.
And it helps us understand what maybe downside potential is or upside potential is, especially if we're recommending an individual position. We reference these levels because they can give us a sense of risk reward. We
Hmm.
want, if ideally you're adding exposure closer to support and you have a lot of room to resistance. So
Hmm.
that's a concept that we keep in mind at all times. So these levels are very key. The catch is the levels are subjective. So there is a lot of subjectivity in deriving these price targets. The objectives also, if you have something that's at new highs or breaking out, you have another way to derive objectives, and that's, we call it a measured move, but there's also something called Fibonacci extensions that you can use.
Hmm.
The measured move is basically taking a 100% projection from a corrective low in an uptrend and vice versa. And it's assuming the prevailing trend will just maintain itself at the same trajectory. And it's an imperfect science, but that's where that 6,900 came from. The most aggressive upside objectives we can derive using these measured moves. And when those objectives are met, it isn't necessarily a bad thing. It doesn't mean it has to be the stopping point for that cycle or trend, but we have found that it's a natural place for a pause to develop. So it can inform our biases around those levels. An example would be that we have a measured move objective that we arrived at some time ago of about 5,000 per ounce for gold. And as we approach that level, which also happens to be pretty psychologically significant, I would
Hmm.
imagine, it would be a natural place for a corrective phase to unfold. And therein we'll maybe respect the indicators even more if we see any deterioration around that 5,000 area. So it's just a matter of nuancing how we're evaluating the indicators that we have at hand. And it's important to note that technical analysis, like most disciplines, can be used for deriving these objectives, but they are estimates, they are opinion based, but they are
Hmm.
informed by the indicators and also these key levels.
Yeah, and I like how, again, you recognize the subjectivity to it, and so you don't, put all of your weight on that one thing. You wait to kind of say, oh, we're maybe in an environment to look for other areas of confirmation that maybe,
Yeah, yeah.
maybe
I
things are.
wish we had that crystal ball that would tell us where the
Yes.
S&P 500 is going to be at year end. We don't, but we can at least put weight the evidence in our favor in our positioning and try to keep the trends on our sides.
Hmm. And I guess the other part when you are kind of setting objectives, again, the news cycle, there's so much that can happen in the intermediate term. I guess how do you kind of protect yourself when you do get these objectives that you're kind of shooting for, but the market gets derailed in the meantime. So are you kind of setting a level below of, oh, this is where if it crosses this level, we need to do something different.
Yeah,
And how do you set
absolutely.
those?
Yeah, yeah. And that's usually would be just a support level that we're watching, below which risk would increase to the downside. And we always have those in mind from a top-down perspective, and then also for individual positions that will use like a nice tight stop loss derived from a short-term support level oftentimes. And those support levels means a potential area of buying pressure, and they can be derived from multiple technical factors: moving averages, previous troughs on the chart or lows,
Hmm.
Fibonacci retracement levels, the cloud model or Ichimoku, which now your charts are adding, which is fantastic. These can all be relevant as support. And this is where I think the art of technical analysis comes in, and it makes sense to just try to get more experience looking at the charts. Because when you see these levels penetrated, what it means is that the buyers that were there before perhaps did not step in this time, and there's information in that. So it all stems from the behavioral elements of the market, and that's how these levels form, and that's why I think they're important. So we always have sort of a breaking point and a point at which things change. then you can take those levels and enhance them also with the indicators. In my opinion, the indicators are a great way to get to a more unbiased takeaway. You can't argue against a MACD sell signal. And then if you had a MACD sell signal and a breach of support, well, then you have more weight of the evidence that things are changing.
Yeah. Now, uh, just help me kind of put two things together, because sometimes, again, you look at the monthly chart and it's very useful for the long term perspective, but I could also see waiting until month end, a lot of damage could be done. So I mean, you could be looking at a pretty serious drawdown, and I mean, we only have to look back to March and April as an example. Now if you waited until the end of April, it was kind of like, oh, no harm, no foul. You just weathered the storm. But how do you kind of, if you're taking a month end approach, how do you deal with something like what happened in March or April, where it's this quick drop that's very dramatic,
Mm-hmm.
and you certainly don't know that it's going to come back, right? It's easy in hindsight to say, oh, well, just, look at the monthly chart and wait until the end of the month. But when you're in the moment, that's not always so easy when you're getting
Yeah,
such a
of
big
course.
drawdown.
And that's why I think the charts are so important because they can help you identify these lows by identifying when emotions are at extreme in the marketplace and also when you have enough stabilization to give us oversold upturns, things of that nature. So the charts can certainly help you time the reentry after such a dramatic drawdown as we saw into the April low last year. But I think the answer you're looking for is how we use technical analysis to navigate these big, sharp corrective phases. And what I will say is an active, systematic strategy is often the way to go because it will take out that emotional bias and the subjectivity. So if you can have a trend following model that is dynamic and will actually track these trends and set it at a risk tolerance that's accommodative to you. I think that's really one of the best ways to go about it. That's what we tried to achieve through our ETF. But for everyone who is doing it at home, I think it's a matter of reducing exposure when you see these breakdowns below support, when you see these MACDs rolling over on the time frame that usually you're concerned with, that means you reduce exposure. It's impractical to think that you're going to reduce it to zero for most people,
Hmm.
but you can temporarily pare it back. And what that does is gives you cash effectively to work with once you have an equity market that looks overdone on the downside based on those same metrics that you were tracking before. We even say something as simple as the 20-day moving average can be really informative in terms of, well, especially after a steep uptrend, once you see those 20-day moving averages roll over, that can be a good time to pare back partial exposure. So it's a matter of almost, reducing your overall exposure, not going down to zero, but going
Hmm.
down to a level that's more comfortable, and then having money to put back to work when you can get that really explosive up move off of a corrective low. So it's a matter of being adaptive. And that's what, even with monthly data, you can see value add from that type of adaptive dynamic strategy in that it will not have time to go fully risk off because
Right, right.
these are 3 month moves oftentimes.
Yeah.
But it will probably reset to some degree, and that should be healthy in that it limits drawdowns relative to the broader market and just doesn't put you as deep in the hole to climb out of.
Hmm. No, that's such a good point. And again, it allows for a little bit more of the incremental moves, it sounds like, as opposed to just, hitting a single button and selling everything, in kind of
Right.
a panic, which, again, sometimes that works to your favor, but a lot of times, especially in kind of choppy periods, you end up buying back the very next day sometimes, and just at higher prices, and you're, you know,
Yeah.
you're,
And
you're, you're selling at lows and buying at highs, and I found that doesn't work so well.
yeah, and you can't time the cycle necessarily in which you're investing. You are invested or not, perhaps. Maybe it's a 401k or an IRA that is just going to always be invested. But what you can control is your exposure throughout those cycles. And,
Hmm.
some people don't have a 10-year time horizon to work with. And that's why I think it is so important to have these trend following gauges on your side over whatever time frame you're most concerned. And for some
Hmm.
people, that might even be quarterly.
Yeah. And you know what? To that end, I want to just kind of circle back because you said earlier how much you love breakouts, and I'm right with you. I love a good breakout, and when you've got that blue sky ahead of you. But certainly one of the frustrations sometimes in a choppy market is you get the breakouts and then you get the failures, and it feels
Mhm.
like, oh, sometimes it feels like pullbacks are where it's at,
Mhm.
because by the time the breakout happens, it's kind of at the end of its move in a choppy cycle. And if you're getting things in support, maybe at moving average lines or what have you, those can be better entries. So, do you ever make adjustments for that type of market where the pullbacks are working a little bit better than the breakouts?
Yeah, I mean, there's definitely market environments that some indicators will work better than the other, and at times we'll be subjective in evaluating the environment. Oftentimes, we're using the long term to inform that bias and saying, okay, well, we know, for example, the S&P 500 is in a long term uptrend. You can see it in the moving averages. So that to us is a trending environment in which will reward trend following or momentum gauges more than will reward overbought, oversold metrics. So I think it's
Mhm.
a matter of knowing which indicators to give more weight for the current environment. Another example would be in an uptrend, if you see an oversold reading, it's really quite rare. So we'll be maybe more inclined to listen to that oversold reading, assuming that no big support levels have been broken. So we certainly consider the overall environment, often taking a look longer term to inform that bias. And there are ways to do it systematically as well. Referencing moving averages and their slopes over different time frames can be added value to that end. Even looking at the slope of the cloud model can be informative there too. So it's just a matter of making sure it's the right time frame for you.
Yeah, and yeah, exactly. Knowing your time frame is so critical because yeah, it really changes depending on. I mean, if you're looking at a 1 minute chart, that's all over the place as opposed to again your calmer monthly charts. Before you go, I wanted to just kind of give you a chance to talk a little bit about your ETF. TACK is the ticker symbol. What is it that you do here to kind of you know give a different take on, or I guess, how do you differentiate yourself in a very crowded ETF market?
It wasn't as crowded when we launched the TAC. That was in 2022, and it was an interesting time to launch a
Mm,
sector rotation fund when it ended up being a year in which really only the energy sector was in the green, which it
mm.
feels like ancient history at this time. But
Right.
yeah,
Yeah.
it's a dynamic sector rotation fund based
Mhm.
on systematic technical analysis and long term, as mentioned. So we are just using monthly data to inform our long term trend following in the ETF. And we are equal weight with our sector positioning. So when the sectors are checking all of our boxes, we'll have a position and it will be an equal weight position. So this year, where we have technology having taken a back seat to a lot of other sectors, it's a great year for a sector rotation strategy to shine and show
Mhm.
its added benefit by overweighting sectors that have a smaller percentage representation in the S&P 500. In stronger tapes, we always supplement these equal weight strategies with tech exposure because tech is what 35% of the S&P
Right.
500. But in this kind of environment, which is characterized by more rotation, it's a great strategy to create like a nice core holding and a way to invest in sectors that might not be on everyone's radar. Whether that's utilities,
Mhm.
staples, eventually these may unfold as represented in TAC. But for now, it's really more exposed to the long term uptrends like communication services, like technology. It's not treating the corrective action that we've seen in some areas of the markets as a bearish reversal. And that's key because that's not allowed it to go below this 75% equity exposure recently. So it's
Mhm.
a dynamic fund, though. It has the ability to go almost fully outside of equities into those short term treasuries, long term treasuries, and
Mm.
gold when the tape does appear to move into a bear cycle and it's impacting all of the sectors at once. So it's adaptive, it's using technical analysis longer term, And with that, the turnover is embedded, and hopefully that allows investors to sleep at night that the fund is just working for them.
Right. No, that's a very important point because again, that's a flexibility that a lot of ETFs don't have as part of their mandate, and so they can't do that. So yeah, that's very interesting. So again, Katie Stockton, very nice having you back on the show again.
Great to be
Really
back.
appreciate your take on everything, and again, that long-term perspective to kind of maybe calm our short-term nerves.
I think that's a great way to think about it.
Yeah, perfect. Thank you so much.
Of course.
That's going to wrap it up for us this week. Thank you so much for watching. And next week, I'm going to actually have George Kachuk back on the show. Gosh, this guy has a really good track record of getting himself in the leaderboard of the U.S. Investing Championship, year after year. He, of course, is a portfolio manager over at RCM Wealth Advisors. So we're going to get his take on how he gets that consistency to be on that leaderboard. So it'll be a great conversation with him. Hope you join us for that. Thanks a lot for watching this week. We'll see you next time. Bye now.